Tomorrow, Jerome Powell will face serious questions about the state of the economy and what the Federal Reserve's trajectory is for interest rate cuts. They'll also be providing us a new summary of economic projections, and they'll likely be asked questions about, put this on your Federal Reserve bingo board, why was the Atlanta Fed real GDP report so low? Now, there are some reasons for the Atlanta Fed real GDP report, but in this video, I'd like to give you my opinion on what Jerome Powell is going to say tomorrow and how he's going to address some of the concerns that markets have. First and foremost, I suspect Jerome Powell is going to very clearly be asked about, hey, the Atlanta Fed real GDP numbers had fallen to negative 2.4% and now at negative 1.8% for the first quarter. Is this a red flag that the economy could be heading into recession? I quickly expect that Jerome Powell is going to turn this question on its head by responding with what the Atlanta Fed has actually written on their staff's LinkedIn pages, though not incorporated into their model. Now, that sounds a little confusing. Why they're communicating through LinkedIn, I don't know, but they are. In fact, what they say is we're in the Fed blackout period, so we can't make big adjustments to the way the formula works, blah, blah, blah. But on LinkedIn, they say, hey, we don't actually distinguish from gold imports, and because of gold imports, GDP numbers probably aren't as bad as they seem. And if you adjusted these figures that we've been getting for gold, you'd actually see GDP sit somewhere closer to 0.4% on the positive side. Okay, now this, remember, is all based on the Atlanta Fed real GDP data, which is very volatile. When we get a bad ISM or PMI read, the number can drop very quickly because the model is designed to be sensitive to the most recent reports to try to give you an idea of how fast is the economy expanding or contracting. The way I think about it this way is sort of like this. Let's say you're driving 100 miles on the highway and you're going from point A to point B on the highway. You've got a 100-mile stretch to drive, and at various different points along the way, somebody is checking your speed. And let's say at the first intersection where they check your speed, so not really an intersection, but scanning point, they say you're going 100 miles an hour. All right, it should take you an hour to get to the end of this road. But then maybe there was a car in your way or something weird happened, and the next checkpoint, they're like, oh, all of a sudden you're only going 30 miles an hour. What's going on? And at the next checkpoint, you're going 100 again. The next checkpoint, you're going 80. Next checkpoint, you're 100, whatever. The point is, you can actually average over that entire path or quarter growth, or in this case, speed, that's maybe 80 miles an hour. But at various different checkpoints have these sort of like shocking data sets, like, oh my gosh, they're speeding, they're going 100. Oh my gosh, they're speeding, they're going 80. On average, still technically speeding. Or, oh, why are they going 30 here? This is really bad. It's very sensitive to that recent snapshot. I believe Jerome Powell is going to tell us tomorrow, hey, once we adjust for these gold imports, yes, we've noticed a slowing, but it's heavily based on recent data. And frankly, it's too soon to tell that there's any material shift in the underlying dynamics of the economy. Instead, it's much more likely that what we're noticing is a response by markets to uncertainty as a result of tariff policy and business decisions that could result from that. See, frankly, if we didn't have political uncertainty, the stock market might not be falling. If the stock market and political uncertainty didn't exist, then we probably wouldn't have consumer sentiment or business sentiment uncertainty, and then we wouldn't have those negative numbers, and then we wouldn't necessarily have a negative, or I should say slightly positive 0.4% Atlanta Fed real GDP number. And I think Jerome Powell, in the position that he's in, he must take an average approach to this, to make sure that he's not responding to noisy data. Imagine, for example, if they said, oh my gosh, Atlanta Fed is so bad, they didn't account for some of the noise that comes with these snapshots, and they cut rates. Sure, things might get enthusiastic very rapidly, but if we truly do have an inflationary issue, then they would be failing that side of the mandate. They'd actually then potentially be forced to raise rates again, which would basically reinvite the 1970s, where the Federal Reserve last truly lost confidence of the economy. Even though we kind of laugh about the Fed and their transitory stuff, they have way more confidence. And yes, trust me, I know, we have little confidence in the Fed. But markets have way more confidence in the Fed today than they used to through this policy of clear communication. That said, what we heard from Dudley last week was that the Federal Reserve might not actually want to communicate very nicely to us because, remember, the Federal Reserve is stuck between a rock and a hard place. If they say things are worsening, markets could fall off of a cliff, and therefore they're likely to want to stay the course. Since public markets are trying to price in 3 rate cuts, the Federal Reserve is likely to only tell us expect 2 rate cuts because they don't want to signal that this noise of some of this latest data that we've gotten is what they believe to be a long-term issue. And so to prevent signaling that this noise is a long-term issue, they'll only give us 2 rate cuts tomorrow on the forecast for the entire year. What could that mean? Well, that could mean that stocks could sell down, or, I know this sounds crazy, stocks could go up, I know, but the bond market is more likely to get hurt. So in other words, we don't really know exactly how the market's going to respond to Powell, because on one hand, fewer rate cuts means, less cheap money. But fewer rate cuts also mean less concern about the economy. And so that's where it's kind of a hit or miss there in terms of how stocks are going to move. But certainly I expect the bond market probably not going to be happy having to unprice that 3rd rate cut and go to 2. Now, that said, this is the interesting if the Federal Reserve has become convinced that this data is more than just noise, then what you really want to pay attention to is, and now for a message from our paid sponsor, Fabric. Meetfabric.com/Kevin. Look, protecting your family and your children should be one of your highest priorities in life. It certainly is for me. I have 7 children, and I would not want to spend a day without life insurance because I hate to say it, you just never know. And family that relies on you shouldn't be left hanging. That's the last group of folks you want to leave hanging. So in my opinion, you want to consider your options. And Fabric provides fantastic options given that it was built by parents for parents. It's designed with families in mind. So what I would encourage doing is checking out Fabric. Go to meetfabric.com/Kevin. Use that affiliated link. Supports the channel, but also gives you an opportunity to check out Fabric. And what a lot of folks are doing is they're not only looking for their first policy, but some are looking for a second policy on top of one that they already have to extend their coverages, make sure their family is protected in the best way possible. So consider giving Fabric by Gerber Life a shot. Go to meetfabric.com/Kevin. That's meetfabric.com/Kevin, Kevin. That this data is more than just noise, then what you really want to pay attention to is, do they align with the market and go for a 3rd cut? Going with a 3rd cut would align with the market, but it would signal that some of this concern is starting to bubble up. So consider some of these scenarios here, right? So scenario number 1, 2 cuts, signals pain for bonds, signals confidence in economy, and this could be faux confidence, right? They might be faking it. Because remember, they have this weird downside bias that if they said something bad, everything would rapidly sell off and crash. If Powell goes up there and says, things are getting bad, the market will sell off like you've never seen a market sell off before. So he kind of can't be honest. I hate to say it. This is why they say he's between a rock and a hard place. One way they could start signaling some of that honesty, but it also risks sending a negative signal, is 3 cuts or more, right? I mean, if you got 4 or more cuts, you could induce panic because people would be like, holy smokes, what is the Federal Reserve seeing that we're not seeing? This is bad and this is unexpected. That's a possibility. This is not necessarily a possibility that we want to deal with, but it's a possibility that could occur. Now, unlikely. I'm going to say this is probably less than 5% likely. I'd say this is probably 30% likely. And as a result, this is probably about 65% likely here. So you get 2 cuts. It signals pain for bonds. It signals confidence for the economy, but it could be bullshit confidence, right? It could be because of the positioning that they're in. So as far as Atlanta Fed, so this is what I think we're going to get in terms of cuts. As far as the Atlanta Fed, I think they'll wash this as noise and gold noise. We'll almost certainly get that explanation. Then, when they're asked about future cuts, they're going to be kind of boring tomorrow. I hate to say it. I hate to poo-poo on it because I'll be live streaming it. I'll be covering it. But I think you're kind of going to get a kick the can down the road. Mostly tomorrow, we get kick the can down the road. The economy is fine right now. A lot of noise around politics, and it will take months to determine, if anything is meaningfully changing. Now, I want you to think for a moment. Right now, the data that we're getting, data now. We just got JOLTS, and guess what it was from? January. Okay? The data we're getting right now, some of the data that we've been getting, like Challenger job cuts reports or import-export prices, inflation data, or all of this. So inflation, pricing, outputs, exports, all this. A lot of this is February data. Okay, well, it's already March 18th. We just had our mastermind meeting on the Ides of March. Like, the Ides of March already came and went. It's crazy. So when would we actually get the largest impact of negative data? Well, consider this. The Trump admin is trying to be a little bit more clear and somewhat cavalier over this idea that the economy's fine. Don't worry about the economy. Okay, y'all want a little bit more clear communication, no problem. April 2nd. How's that for clear communication? So now all of a sudden, clear communication is April 2nd. This is, by the way, on the face of us not really getting too far with the Russian Putin-Trump talks today, which I talked about in the Meet Kevin report this morning. I'm like, I don't think Putin's going to roll over here. I wouldn't be surprised if you don't actually get anything today. And most of what you got today was a talk, which is a start. I'm not trying to poo-poo Trump here. I'm just saying, I don't think Putin's going to roll that much. But you basically got an agreement to continue to negotiate. So it was sort of like a negotiation phone call to agree to continue to negotiate. In legal terms, you got a continuance. For normal people, they kick the can down the road. Okay? That's just sort of the way politics works. Unfortunately, politics, it's so freaking slow. And I want you to take that from me as from the point of view of somebody who ran for governor in California, just the things that I've learned in the process of politics, many years ago. It's way slower than people think, even when you have the appearance of control, like party control, like Trump does. Anyway, so this clear communication deadline of April 2nd tariffs. Well, let's think about that for a moment. So April 2nd tariffs, when those actually hit, first of all, you have to think about the front running. Front running could basically continue through the end of March. Okay, so the end of March data doesn't do us much good. When does the front running end? Well, obviously when you can't front run anymore, which would be like April 2nd. So April 1st would be the end, right? Okay, so when are we going to get nearly a full set of data for April? Well, April data will come out early to late May. Some of it won't come out until mid-June. We're literally getting data right now in mid-March about February. So in other words, we might not have a full, clear picture of the impact of these April 2nd tariffs until mid-June. And by mid-June, I would expect a lot of the inflation fears will evaporate. The reason I say that is there's so much front running right now. You're building up inventory at today's prices, putting more strain on shipments today to try to use that inventory while the tariffs hits so you could get through the hopeful April, May, June, July, August, whatever the tariffs are in effect for. And then when the tariffs go away, I don't know when they're going to go away, but at some point the tariffs will go away. It could be months, it could be years. At some point, you'll have to start either buying new inventory or the tariffs go away. I think there'll be a new free trade agreement at some point. I see a future where Trump goes, make trade free and great again. Something like that. I don't know. Make free trade great again. It's going to happen. And if it's not him, it'll be the next president. Somebody that is such a low-hanging fruit to bring back free trade. So it'll come back. But for now, people are trying to basically buy time and get through those tariffs. So the downside is April will probably be the worst month. April is the month where I think a lot of the inflation fears will evaporate. But in addition to that, I think you could end up still seeing uncertainties from businesses and people, but on top of those uncertainties, sales fall. And then that's when you're really going to start getting the Q2 and Q3 forecasts that look poopy doopy for businesses. At that point, I'm not sure the market is going to be talking about all-time highs. I think the market's going to be talking about lows relative to 2022, which isn't great. Now, I'm like, you know me, I've been very transparent. I've been a 2.5 on the bear bull scale for a very long time now. It bobs up and down, but it hasn't been above a 5 in a very long time. And I get bearish when markets sell off at the beginning of the day and the end of the day. I don't know yet what's going to happen today, but at least who knows, maybe it'll rally today. But what I saw yesterday is a giant plummet at the end of the day after a midday rally. This is usually retail. This is usually institutional. And so when you look at the end of the day yesterday, the beginning of the day today, you have a little bit of an institutional sell flow coming in. I am starting to see more and more people that are saying, do not expect a Trump put and do not expect a Fed put. So basically, the death of the Trump and Fed put. Those are two puts gone. Those are your insurance policies gone. Okay. That's bad because when those are gone, you're now likely to face institutions who say, you know what, let's just sit on the sidelines. Why don't we just milk some treasury yields for a while? Let's hedge. Let's get out of the noise of the market for a while until we see what's going on. As a long-term investor, do I think it makes sense to flee and sell everything? No, I never think that is the best for a broad sector of individuals. Personally, I'm putting a lot more money into what gives me a 5% yield, downside protection, and upside away from the equity market. But that's also a product we created at HouseHack, and the reason I created that product is because I'm frustrated with the equity opportunities that exist. And you've seen this for many months. I've been like, I don't know. And I'm not saying there aren't other deals. Like you could look at the 2-year treasury, for example, or even honestly a 6-month treasury. 2-year treasury right now yielding you 4%. How about a 6-month treasury? Right now, my take is equity valuations, while they're slowly coming down, still a little on the rich side. I think you'll get buying opportunities, but you want to be careful that you're not buying into weakness. You want to buy into strength where people aren't seeing it yet. And so while I like some of the corrections that we're seeing, I think there's a lot more pain that could potentially come once people realize Powell's not going to be here to bail us out. Now, hopefully the market recovers and everything does well, because really nobody wants to be in a place where they're worried about job loss or whatever. I personally think one of the best things you could personally do right now is hedge yourself by thinking about how can you go buy the dip when the dip is really bad, if it happens. How do people do that? Some people like buying like a 6-month treasury bond. They leave money in cash. That yields about 4.25% right now. And when the Federal Reserve starts panicking, that's when you want to be a buyer. Like you want to be the person that has a job, has income, has cash, and you're able to buy. When Jay Powell's like, we will secure any credit. Credit all of a sudden froze. Nobody's hiring. We will secure all debts. We'll start buying stocks. We'll do whatever we have to do to stop the pain. That's when you want to be buying. But what you're getting from the Fed, and what I think you're going to get from the Fed tomorrow, is everything's fine. Don't worry. Nothing to see here. I don't believe that. Call me skeptical, call me a bear, call me names in the comments. It's fine. That's what the comments are for. You can say nice things too, I suppose. But from an honest, just like human point of view, I can't be the person that's just going to tell you to your face, hey, I'm buying, more NVIDIA today, and I'm buying like 2 shares of NVIDIA just to make it seem like I'm always a buy the dipper. I think it's ludicrous. I think it's a lie. I think it's disingenuous. I can't do that. And I'm not like pointing the finger at people. I'm saying the industry does that. And it's as a way to manipulate hope. People like to buy into hope. Well, I don't have much hope for the equities right now. So sorry, it's not me. But I will tell you, there will be a day when I flip and I'm really bullish on equities. Personally, I think there are great opportunities for you to raise cash. Get some yields, get some cash flow. If you get some dividends that are safe, be careful. There are a lot of risky dividends out there. Get something that gives you upside away from the equity market. Go buy a house yourself. I will never be the kind of person that says, don't buy real estate yourself. Just be careful which market you buy in. You got to look. Some markets are bottoming, some markets are still doing well, so you have to sort of evaluate that very carefully. But I hope this is all useful and insightful for you, because Jay Powell's probably not going to be nice to us tomorrow. He's probably going to be mean to us tomorrow, and I just want you to have a warning that it's coming. So we'll see. If we're pleasantly surprised, then I'm more than happy to say, wow, what a shocker. We got an honest Jay Powell. I'll call it like I see it. And I hope you subscribe to the channel knowing that I'll always tell it to you like I'm seeing it. Thanks for watching. We'll see you in the next one. Goodbye. Good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.